It's been a wild few months in global markets. The S&P 500 index of major stocks rose sharply after Donald Trump won the US presidential election in November, and then fell almost 10% between mid-February and mid-March as the reality of the president's policies sunk in. Yields on 10-year US government bonds rose from 4.2% in December to 4.8% in early January, and then came back down again. The trade-weighted value of the US dollar has made a similar round trip. It's a baffling landscape for investors to navigate, and it's increasingly hard to reconcile the broad movements in global markets with the basic tenets of investing. I'm talking about the idea that investors should build a diversified portfolio of stocks and bonds, that they should look for solid companies at reasonable prices, that they should aim to hold their investments for a long period of time, and that they should keep their costs down, and that it's impossible to time the market, so don't even try. So this week on The Big View, we're going to explore to what extent the ideas of basic investing still apply, and if not, what has taken their place. It's what we do at Reuters Breaking Views. We tap our best sources around the world for fresh insights on the biggest stories in global business, finance, and economics. I'm your host, Peter Dallas. To talk all this over, I invited Mark Haefele onto the show. Mark is the Chief Investment Officer for Global Wealth Management at UBS. Swiss bank is the world's largest wealth manager, steering over $4 trillion in assets for its clients. Mark was the co-founder and co-fund manager at Sonic Capital and was an acting dean and lecturer at Harvard University. He's also just published a book, The New Rules of Investing: Essential Wealth Strategies for Turbulent Times. We recorded this conversation before Donald Trump's tariffs on April 2nd triggered the latest wild gyrations in financial markets. But what Mark has to say remains highly relevant for investors dealing with turbulence. Mark Haefele, welcome to The Big View.
Thank you, Peter. It's great to be here.
So there's a lot I want to talk about, but I want to start with a broad question prompted by the title of your book, The New Rules of Investing. When exactly did the rules of investing change?
Yeah, so since I started about 30 years ago, I've noticed three things that have changed, I think, that are critical to investors. The first is government intervention in the markets, which has increased. The second is the rise of behavioral finance, which I've found is crucial for investors in the practice of advising them. And the third thing is the rise of impact investing, where some investors focus not just on their returns, but also on measurable social goods, so that they're using their investments and philanthropy sometimes, but they don't see their investing as separate from philanthropy.
So I think we want to explore all three of those. But maybe I can sort of start with the behavioral science kind of question. Can you talk about that a bit more? What have you seen, or what has evolved that has made a difference in the way that people approach investment?
Yeah, so I think from a theoretical perspective, when I studied, it was kind of that people were assumed to be rational actors pursuing profit maximization strategies, perhaps. And we just know that that's not necessarily the case. And I think, what I've experienced in my work working with clients around the world, for just as an example, one of the things I think is really interesting is helping people to think about their wealth in three buckets. We call it the 3L approach, or the wealth way, which is thinking about liquidity, longevity, and legacy. What do I need today? What do I need over the course of my lifetime? And what am I thinking about in terms of my assets to help other people or to go beyond me? And, at the end of the day, money's fungible. And so for a true rational actor, it's all one portfolio. But for people, when they think about that liquidity bucket and having, say, 3 to 5 years of liquidity, that completely changes their relationship to their investments. So all things I learned as a practitioner along the way.
Yeah, that's really interesting. Because I do think also, I mean, if I think about sort of the kind of popular rules of thumb that people get told about for investing, I mean, some of those are designed also to resist or filter out some of the behavioral stuff you're talking about. So for example, you always get people say, well, ignore the short-term gyrations in markets. You can't time the market and so on. Are those rules still relevant?
I think they're absolutely relevant. The problem is, though, if all it took, was to read another web page to internalize these things, we'd all be billionaires. We'd all have six-pack stomachs. We'd all have PhDs, and it just doesn't work that way.
Yeah, that's true. So talk a bit about you wrote quite a bit in the book about the growing role of governments in markets. Can you expand on that a bit? I mean, how does that manifest itself when it comes to investment?
Sure. I think, one of the reasons I wrote the book, my partner in this, Richard Moraes, he wanted to do this book for a long period of time, and I kind of kept putting it off. But then with COVID, I said, okay, now I really got to think about this now. And this is a great time because what I noticed was a chart that showed government expenditure as a percentage of US GDP, and it was at the same level as World War II. And I thought, hey, hang
Mm.
on a second. World War II was probably a time where you might have to look at your portfolio and your strategy and think a little bit. And here we are back at that. So where are we indeed? And then as I looked at it, of course, over the course of my career, when I started, say not when I started, but in 2000 or so, when long-term capital blew up, that was solved without government money. And then we get through to, say, the great financial crisis, where we started with it not being using government money, and then it very much ended up being about government money. And then through the pandemic, where the Fed deployed all of the tools that it used in the great financial crisis in about 4 days. Uh,
Mm.
that's those. There's many things along the way that I think have altered capitalism as we experienced it, say 25 years ago.
No, that's really interesting, and you can definitely, yeah, you can definitely look at those periods. I mean, you talk about the financial crisis. I guess then afterwards we have that period of ultra low interest rates, where sort of central banks kind of kept everything sort of ticking over, and then obviously COVID. But I mean, I wonder if there isn't also something a bit more fundamental going on, which is, for a long time, I would say most of my working life, probably yours too, there was this idea that governments wanted to sort of broadly be aligned with markets, right? They designed tax structures and policy framework with the express intention of attracting capital. There was a sense of, you didn't want to interfere with the markets too much. Although obviously in 2008 and kind of subsequently during COVID, there was also then that turned into a sense that you then had to also stop markets from correcting or falling out too badly. But feels like it's early days, obviously. But in the last few months, really, since the election of Donald Trump for the second time, um, there's also a bit of a feeling of like, well, the governments may be actively hostile to investors, or at least some investors, right? That maybe the interests of investors and governments, broadly defined, are less aligned than they once were. What do you make of that?
Yeah, I mean, I'm going to be a little bit challenging on this and say, I think I'm a little less interested in judging things than understanding how things actually work. And let me explain a little bit. There's always been these narratives like, well, the Wild West wasn't wild, or it all came about because of land grants that the Congress gave to the railroads, and the fur traders of the earlier period were tied into this global capitalist network to funnel beaver pelts to London or things like that. So
Hmm.
we can always say that actually there was never unfettered capitalism, or we can say, to your point, that these things worked hand in hand. And I think there is a absolutely aspects of what we've seen in the Trump administration, maybe that exemplify some of the changes that have happened. But I think, the I think some people would say that actually the during the great financial crisis, the government actively chose winners and losers.
Mm.
Maybe we just agreed. Those of us who are connected financial markets like the fact that rather than letting uh, capitalism take its course and these banks or others go down with the ship, that they chose to make them winners instead of losers, right? So I'm just not sure how much it served to kind of pass judgment on it versus trying to realize, okay, what is actually going on here?
I see, but essentially, your point is, and if I understand what you're saying correctly, it still is the case that the government is playing a really big role in shaping the way markets perform, and you just, as an investor, you have to sort of accept that and then sort of try and get ahead of it. Is that the idea?
Well, I mean, first you have to realize it, right?
Right.
We're having a very intelligent debate about what is the relationship of government and capitalism or investors, and and I think we can debate it, but I'm arguing in the book, uh, buy what the government's buying, figure out what the government's buying, and because that is an enormous, it's kind of follow the money, and following the government flows has become very important to how you invest today.
So, just on a practical level, how do you sort of stay on top of that? I mean, we're all inundated with information, with news flow, with announcements on social media, headlines, people saying things, um, and a lot of that is noise, right? A lot of it is, it doesn't really amount to very much, or people say things and then they say something else, and it sort of flips back and forth, and you can sort of see markets trying to understand what's going on, trying to react to it. But how do you sort of just on a day-to-day level, how do you approach all of that? And how do you try to sort of filter out what's important from what's not?
Yeah, look, I think that it's an important point, and separating the forest from the trees is really important. And look, I mean, I myself and my team, we do this day in and day out with uh, passion and kind of a relentless focus. So we're very focused on the trees, but we also need to see the forest as well. And I would say for most people, they really got to be able to see the forest. And what I mean by that is, it's the beauty of especially the democracies, right, is that they are loud and proud about how they're going to spend money. An example is the IRA Act,
Mhm.
where you could have waited until after the legislation was passed and signed, and then the money starts to flow. But infrastructure did enormously well in the year after this Inflation Reduction Act was passed. So, uh, in many cases, it's really not that hard. You just have to take that step back. Likewise, today, I think one of the things that we focused on is the very large and persistent uptick in central bank buying of gold, and noted that as a phenomenon that fits with this. And then you could say, there was all this talk at the turn of the year about crypto and the US starting a crypto reserve. Okay, well, should we be buying what the government's buying? And then it's come out since then, I mean, to date, actually no taxpayer money is going to be spent on crypto. It's going to be funded with assets that have been seized in the United States, right? So, okay, and crypto sold off. So I think, while the administration has changed, I was a little worried because I wrote this book obviously during the Biden administration, but I really see these ideas still working today, and in some ways even working better.
But that does sort of run counter to the old kind of investment mantra of you can't time the market, right? You should sort of position your portfolio and kind of hold it for the long term. And the mistake that people make is that they rush in and rush out because they tend to buy when stocks are high, and then when there's a panic and everything sells off, then people get rattled and sell. And you should resist that temptation. But if you're trying to anticipate what the government's doing and responding to it, then inevitably you're trying to time the market a bit, aren't you?
I think there is that aspect of it. What I try to do in the book is that if I was going to say it's split into three parts. The first part is a little bit, I have experience starting a hedge fund, being a hedge fund manager, and so there is part of the book that is okay. How do you make it if you really want to devote yourself? How do you make your money? Part one. Part two is how do you keep your money, and then part three is what do you do with your money based
Mm.
on my experience working with clients. And so there is the first part is a little bit like if you really want to make your life miserable and trade stocks, put down some of the classic value investor texts and focus on this theme of buy what the government's buying. That's that should inform how you do research. So, rather than looking at the S&P 500 sectors, maybe pick up some of the big themes that governments spend their money on like AI, digitization, like healthcare, which is a demographic issue, or like sustainability or decarbonization. We call those three the 3Ds. So it's a way to think if you want to be an active investor. But the second part of the book is indeed about like, unless you're going to do this every day professionally, uh, then you're like a guy who takes his family out to, who pilots a plane on the weekend 3 times a year and then puts his family in the plane. Is that really the safest thing to do? Much better to follow the rules that you talk about, which is asset allocation, not trying to time the market, but rebalance your portfolio when it gets out of whack. So, and then the third part of the book is more about the impact investing, which I think is the future. So that's how I reconcile the very astute point that you made.
Yeah, no, that makes a lot of sense. I want to come back to I love that idea of the amateur pilot, but let's come back to that in a bit later. I just in terms of what's going on in the markets at the moment, when we sort of get these shifts, people often reach for historical analogies. So you see people talking now about, oh, it's like the 1970s, or no, this is actually like the 1930s, and I just wonder, is that approach helpful in your view? And is there a sort of a period that is worth studying at the moment that would give people some guidance or some sort of way of thinking about what's going on?
Well, in the back of the book, I do highlight a bunch of books that I think have been influential to me in thinking about investments. One of them is a book by a former professor of mine, Bernard Bailyn. It's on the ideological origins of the American Revolution, and basically, America was founded on a conspiracy theory. You had these everything that Parliament did, the farmers and merchants in America, as he argues it, were obsessed with these historical analogies from British history where it was going to lead to the tyranny of the king. And, I see that, and there's other books, the paranoid streak in American history. So
Mhm.
I see that today repeating itself where people, uh, you know, want to decipher this is a clear trajectory towards anarchy, debt ruin, and I would say take a breath with. I mean, I've got a PhD in history. I love these debates, but I don't think it's necessarily the most useful way to interpret current events. I think there are aspects of it that are important, like nations tend to run into trouble with debt, and they tend to use inflation as a way out of that. I think that I think that is an historic importance. I think that looking at the way nations have dealt with crises in the past, during the Great Depression, for example, the U.S. outlawed the financial holding of gold. I think that's
Mm,
interesting. But
yeah.
these broader analogies that we're headed straight towards, you know, the idea that it's 1938, I don't think that's really a useful framework.
Okay. Um, just sticking on that theme a little bit there. I mean, obviously, one of the big themes in recent years has been this idea, which people call American exceptionalism, right? US markets were sucking in capital, companies from all over the world, outperforming the rest of the world, largely powered by these giant tech stocks like Apple and Nvidia, which are bigger than the entire stock market of several, medium-sized developed economies. Um, that was sort of the very strong narrative at the end of last year. I think people are now revisiting that. Uh, how do you think about that whole idea, and do you think we're sort of at a turning point?
Well, first, I think you have to separate the economy from, the Magnificent Seven. And I
Mm,
think that, uh, that there are aspects of American exceptionalism which have not, uh, certainly are not gone. For example, I don't think there's no alternative to the dollar as a reserve
mhm.
currency that is meaningful yet, and I don't think there will be one for some time. There, the U.S. military is still the most powerful military in the world. Um, the U.S. kind of pay, control of the payment system and technologies and things, platforms. These all persist. I mean, they may be eroding. But I think it's at a much slower rate than people anticipate. But on the flip side, the uh, the Mag Seven or other aspects of the U.S. market could be very sensitive to the second derivative of those underlying changes. Now, I think we have a view that actually, given the strong cash flows, at some point this comes down to earnings. Maybe there's some fluctuation in the multiple you put on those earnings, but these
Mm.
U.S. companies are still going strong and still have tremendous advantages, compared to some of the other companies around the world right now.
Yeah, no, that's true. And people often, I think that sort of idea of the fundamentals gets a bit lost sometimes. And also, I guess it's tempting also to sometimes when you get a bit of a correction, it's tempting for people to sort of read into that a broader shift. Um, I just want to just come back to that your analogy of the person who's sort of the amateur pilot flying his family around at the weekends. Um, I mean, your clients are wealthy people, right? They have tax advisors, they have accountants, and of course they have their financial advisors who can sort of help think about things, who can give them advice, who can structure things. Um, I just wonder when you're sort of thinking about the advice you're giving to people, or you're sort of writing this book. To what extent are these lessons relevant to us, sort of more, mere mortals with, kind of a bit of savings and a bit of retirement money to play around with? Are there sort of are there analogies that still make sense for the sort of the broader public when it comes to investment?
Yeah, I that's one of the parts of this book that I really love because I try to give examples which there are examples of how the rich and influential do think about their wealth differently, and I think they're important. But I also think there's plenty of examples in the book about how the fundamental starting point for people is learning about themselves, their own financial hangups, and you know getting the emotion out of the equation as much as possible when they invest. And so, I would say it doesn't matter what your net worth is. Uh, if you don't know your own emotional hangups or other things, when you bring them to the table when you try to invest, they're going to cost you money. And I think that advice, that's completely universal. I touched on it, at the beginning with this 3L framework. Literally, in the past month, I've met with the family office of one of the biggest rock stars in the world. I've met with, the the principals of a large family office. I meet with individual investors, and I've yet to find in all those conversations the thought of bucketing the money between the liquidity, longevity, and legacy became really important to the conversation. And so it's really universal.
Okay, so we can you can invest like a rock star, or at least like a rock star's family office. It's a good guideline. I want to come back to the something you said at the beginning, where you talked about the sort of the rise of impact investing being a big factor. You just sort of expand on that a little bit. What exactly do you mean by that?
Yeah, and look, I think this is an area where, unfortunately, there just aren't yet all the tools available for the common investor to really make the kind of impact investments that our savviest and richest clients are making. But it flows from this idea that there. If you think about people who have foundations that the foundation just invests money however they invest. I mean, in the extreme example, you could have a foundation that the investment team is investing in, oil companies, and the foundation gives all its money to clean air charities or something
Hmm.
like that.
Hmm.
And things like that happen. And then today people are saying, well, hang on a second, why don't I use the investment side to invest in, say, wind farms and solar panels or whatever they believe in, and then to generate the investment income to also support the charities I believe in. And this is really kind of trickling down in the way that people think about things, because another things that's changed over the past 30 years, our problems have changed. And now things like climate change or clean water or deforestation, these are universal problems that they're just too big for governments to solve. And if some of the retirement savings of individuals is not directed towards these topics, we have really no hope of solving them. So I think that's a change in the industry, but also something that individuals have recognized and tried to make a dent in.
When you're talking to people about these types of investments, how explicit is the idea that there is a trade-off in terms of returns? Because I feel like sometimes with some of these ideas, when they get talked about, there's a little bit of a sense of you can keep investing and you can keep making returns and you can also sort of do good at the same time. So how do you approach that question or that tension?
Yeah, well, look, there's no way that we're going to unlock all the retirement savings in the world if there is you have to give up returns to invest in a socially responsible or socially productive way. So I tried in the book to find, very good examples of how people who are not compromising on those things, and we try to focus on that. For example, when we set up a few years ago a fully sustainable investment multi-asset solution, we did something like replace U.S. government bonds with World Bank bonds, and actually they had a little bit of a yield pickup, and they have a higher rating. And we had to work with the World Bank to make them fit with private individual portfolios, but it was well worth it. So I think you specifically looking for the opportunities to not compromise is that's what gives me passion in this, because I think it's necessary. And I think investors realize that, you can invest in a green bond that finances the replacement of air conditioners at an oil company's headquarters. That would be a green bond, and it might marginally do some good, but that's a heck of a lot different than providing seed capital to a company that's going to bring water filtration to remote communities in Africa, right? And I think moving where you sit in the capital structure is also something more and more clients think about, and that's exciting as well.
And has that? I mean, obviously, investment there are always kind of cycles and fads and so forth. What makes you sort of confident that that's an enduring factor, that people will continue to be interested in that, even if, despite the sort of the ups and downs of particular markets or particular types of investments?
Yeah, look, there's no question that there's been a lot about talk of greenwashing and things, but I know that this is very much on the radar of clients. The reason is because of this great transfer of wealth, and the younger generation that we work with, often, I've heard it said that the dirtier the money was made, the cleaner that the next generation wants it to be invested. And
Right.
and this is an enduring trend.
Well, that's I mean, that may be a good optimistic note on which to end. But Mark, this has been really fascinating. Thank you for taking the time to come and talk about this, and we will keep track of the new rules and see how they apply in future.
Thank you, Peter. A lot of fun.
That's all we have time for this week. This podcast was produced by Oliver Taslett in London. You can listen to a new episode of The Big View every Tuesday on the Reuters app or your favorite platform. Don't forget to tune into our sister podcast, Newsroom, every Thursday, as well as the other great podcasts from the Reuters team. A daily dose of the biggest global stories from Reuters World News, and a weekly deep dive into an economic concept behind the headlines at Reuters Econ World. If you liked what you heard, please follow The Big View and let us know what you thought. And check out our views on the biggest stories in business and finance every day at breakingviews.com and reuters.com.